The Toronto real estate market is going through major changes. In this type of environment, you need to get the facts straight to make informed real estate decisions. So stick around because, as always, I've got the numbers to prove it.
Facts are meaningless. You can use facts to prove anything that's even remotely true. Facts, Max.
The current supply in the downtown Toronto market is 1,201 units, which is an increase of about 10% from the previous month. But as you can see, there was a slight dip in the supply, then an increase here. As we mentioned in a previous video, the listing inventory historically picks up in the fall every single year as people get back into business mode after vacationing during our precious Toronto summer. I'll give you another fun fact. Historically, this only lasts for about 1 month before it starts to fall again. Let me show it to you. You can see from this historical graph that inventory increases like this pretty much every single year from these little upticks on the graphs here. To make it even easier for you, I've broken down these numbers even further for you on this chart here. You can see the green is an increase in inventory from August to September in previous years, while the red is a decrease from September to October. This is from the period of 1996 to 2021.
Go outside, nerd.
Yes, I admit I have nothing better to do but spend all my time looking for trends and competing numbers for your viewing pleasure.
Nerds need to do things like this so they get attention online.
To simplify what I just said, historically supply goes up in September and then drops in October again for the rest of the year. This started to happen this year as well. As you can see, supply drop here, but then if you look at what's happening this week, the inventory is starting to go the other way. This graph shows you this fact as well, but this week may be an exception. I'll watch carefully because if inventory starts to build over the winter months, it's going to put downward pressure on the price. It seems like sellers were holding off on putting their listings on the market, but is this the start of the change? If we see an increase of inventory flooding the market during the winter months, that will be bad for prices. By the way, hit the subscribe and like button for something good to happen to you. You can see from the 6-year graph, there is more inventory compared to the previous years, with the exception of a huge inventory spike during the COVID lockdowns in 2020. This is an active listing distribution. We will watch this in the coming months to see if there are more listings in the lower price points. There were only 351 sales in September, which is a drop of about 48% compared to last year. This is the lowest September in 14 years. The last time it was lower than this was in 2008.
I expected it to be, pretty bad, but this is really bad.
This graph proves that sales have been steadily decreasing since the Bank of Canada started aggressively raising rates, starting on March 2nd, 2022. The list price sales price ratio, a demand indicator, is now down to 98.8% as condos are selling for less than their asking price. You can see that this is starting to level off as agents are now pricing more realistically with the market conditions, although we do still see the occasional bidding wars. In September, the average listing days on market was 25 days. If you are selling in today's market, know that it's going to take a lot longer to sell your condo, and if you're overpriced, you're probably not going to be selling at all.
Not for that price.
Average price in September increased to $820,864. This was a 3% increase compared to last month, but a 7% drop from the high in March. Compared to last year, it's only a 0.4% drop, but it looks like it's on an upward trend. This is not in line with the other economic indicators. So what's going on? I'm sure some of you would use this metric and say, see, the market is bouncing back, Tim. You don't know what you're talking about with all your numbers.
Be careful.
So let me teach you another lesson. I told you before that with average price, you have to be careful with outliers, as with a lower sample size, outliers will have a bigger impact on the average price. You want me to prove it to you? I thought you'd never ask. Here are the sales over $2 million in July, August, and September. As you can see, September had 6 sales over $2 million with a smaller sample size of only 351 sales, compared to over 430 for both July and August.
Perhaps you're right.
This is why I'm not really a fan of average price for sales numbers. So don't use this as an actual market price metric, especially you realtors.
Sounds like you have mental problems, man.
Yeah, you got mental problems, man.
Yeah, it really does.
Next time someone tries to pull an average price metric on you, remember this lesson. On the other hand, median price has dropped to $717,000 in September. It's a $3,000 drop compared to last month and an 8% drop from an all-time high in February. Compared to last year, it's only a 0.3% drop. So we are pretty much at the same price as last year. It is on a downward trend, which is in line with the other economic indicators. Now here's a more reliable indicator, and as you saw from our previous videos, our relationship is really starting to blossom.
Swing!
Swing!
August HPI has dropped to $805,850. It's a 1.8% drop compared to last month and a 10% drop from the all-time high in March. If you look at it compared to last year, it's still up by 8%. But if you look at my previous video, this metric decoupled in August of 2021 when the numbers changed. So I would take the 8% increase with a grain of salt. This is also on a downward trend. As a market value indicator, I still have my doubts using the HPI index, as you've seen the reasons in my previous market videos. However, it's consistent with the current market indicators as prices should be on a downward trend. Here's a chart of all the unit types broken down so you can know what specific unit types are selling for. When looking at the median price, pretty much each unit type is priced lower compared to 2021, with the exception of 2-bedroom plus dens. You'll also notice that the sales volume are almost cut in half, with the exception of 3 bedrooms. Again, this reinforces the evidence and outliers in this month's numbers, skewing the average price this month. Correct. All these metrics show that the Toronto downtown condo market is cooling and that prices are coming down. This will continue as interest rates continue to rise. I mentioned in my previous video that the only counter to this is dropping supply. If this week's numbers are any indication of the future trend and supply starts to build up, we will see a continued cooling on the market as buyer demand falls and supply increases. On September 7th, the Bank of Canada raised rates by 0.75%. They are expected to raise rates again by another 0.5 or 0.75% on October 26th.
That's very dangerous.
Now let's dig into the rental market. The rental market is starting to stabilize. If you watch my previous video, I mentioned that this would happen, as this typically happens every fall.
I am too smart.
There are 1,020 active rental listings on the market right now. That's a drop of more than 39% compared to last year. However, we've seen inventories this low before in 2017 and 2018, as you can see from the historical graph before. As you can see from this cluster here, inventory has been somewhat balanced for the past 3 months. But if the last 2 weeks are any indication, inventory might be starting to build up again. Here are the current distribution of rental listings. You'll see where most of the active listings sit on this graph. Rents under $2,000 are pretty much non-existent downtown.
It's not possible.
There were 1,438 leases completed in September. That's a drop of 12% compared to last year. However, this is still relatively high compared to the past 6 years. As you can see from the weekly distribution, we can see the demand falling as we head into the winter months as previously predicted in my previous video.
I don't want to freeze my butt off in the cold.
The list price rent price ratio is now 101.27%. You can see that it's cooled off from the frenzy of July and August, the historically busiest months of the year.
That was agonizing.
Days on market has increased to 11 days, which is indicating that the demand is slowing. The average price is $2,949, down slightly from the record peak of $2,973. Compared to last year, it's up by 17.6%. Median price is the same as the previous month, a record high of $2,700. Compared to last year, it's up by 20%.
Holy guacamole!
The rental prices are now stabilizing as we now enter the slower months of the market. We should continue to see this until March or April of next year. It'll be interesting to see if inventory stays low or if it picks up. If I'm a betting man, I'll wager that it'll stay low as we are not seeing as many buyers being removed from the rental pool as interest rates have really jumped up, so buyers aren't able to qualify for a higher mortgage in order to buy as prices haven't really come far down yet. Here's a chart of breakdowns of rents across different condo types so you know what rents are going for. As you can see, all prices are up significantly compared to previous years. It now costs you over $2,500 on average for a 1-bedroom in downtown.
This is getting really expensive.
Now let's see what's happening to the investment potential of condos by looking at the PR ratio. This metric is like the price-earning ratio for the stock market. See my previous video for a more detailed explanation on how I calculate this. Moving forward, I'm only going to be using the median price rent ratio as I don't like the average price or HPI for this ratio. So goodbye.
Oh, let me taste your tears, Scott. Your tears are so yummy and sweet.
The current median PR ratio is 22.13. The lower the PR ratio, the more real estate becomes attractive as an investment vehicle. The PR ratio assumes that you pay all cash without taking the interest rate into effect. I know interest rates do play a huge factor into your overall investment analysis. I'm just using this as a similar metric to track the investment potential, just like we do in the stock market for you finance guys out there.
Oh, sell.
Now, in conclusion, we are seeing prices coming down, and currently they are at pretty much the same level as they were last year. If this week's numbers are any indication, inventory should start building up. There was also a huge drop in demand. With further rate hikes, we are going to see prices come down further. This was best described by the legendary investor Warren Buffett. Interest rates are to asset prices what gravity is to the apple. When there are low interest rates, there's a very low gravitational pull on asset prices. It will most likely take some time before the market adjusts to the higher interest rates, and I'm sure there will be collateral damage on the way, as there were definitely speculators who overextended themselves by purchasing real estate they could not afford.
What could possibly go wrong?
On the flip side, this is going to bring about a rare opportunity to pick up some Toronto real estate at depressed prices. If you've been following the market here in Toronto, prices rarely drop, as we've seen unprecedented population growth with government red tape that keeps supply low. I said this last time, but I'd rather pay a lower price and a higher rate than the other way around, because interest rates will eventually come down again, increasing my returns. Once the Bank of Canada performs their soft landing, this will prompt them to start cutting to stimulate the economy, and the cycle will most likely start all over again. Bad markets create opportunities and teach speculators a lesson. But people always forget, as we forgot the lessons of the 90s. For those of you who have been around long enough to remember, you'll know what I'm talking about. So for those of you who are actually paying attention and understanding opportunities, we are heading into hunting seasons. So wake up and start tracking your favorite markets. Hang on, because I think it's going to be one heck of a ride. Do you agree or disagree? Let me know in the comments below. Click this video here to see what happened in my previous video and to learn more about what happened in the market last time. I'll see you in the next video.